Okay, so what we'll be looking in this video is we'll have a look on our depreciable assets. So those fixed assets of us, so for example, our motor vehicles, computer equipment, machinery, and just the loss in value of those assets and how we deal with it in accounting. Okay, but before we get to that, let's quickly have a recap. So in accounting, your fundamental principle in accounting is the double entry system. So for every transaction, it has a debit as well as a credit. And that comes from our accounting equation. Our accounting equation is stated as our assets equals our equity plus liabilities. Or we can rewrite it as being our equity, the owner's wealth, or your wealth equals your assets, what you own, less your liabilities, what you owe. So assets, what are assets? So assets are resources to you. So it's something that will bring value to the company. So in other words, it's either cash, money in your bank account, or it's likely to be converted into cash at some point in the future. But most important is assets are resources. You use it to make cash. Okay, it brings value to you. A liability is a present obligation, so it's the debts of the company. So we have an obligation to pay back someone. Whereas equity is just the residual value between your assets less liabilities. So in other words, your equity is just the owner's wealth. Equity increases when when the owner makes a capital contribution. It also increases when the business makes a profit, and it decreases when the owner makes drawings or when the business makes a loss. And then our income is revenue or gains made, and expenses are the costs incurred in the ordinary course. So getting back to the double entry system, what do we know? That every transaction has a debit as well as a credit. So if we look at our assets, expenses, and drawings, whenever any of these accounts increase, then we will debit that increase. And when it decreases, we will credit that increase. So for example, if we have if we buy a new vehicle, so firstly, every transaction has two sides. So we bought a vehicle, so our money left our bank account. So our bank account being an asset, we will credit that money in the bank account, and we will debit the increase in the vehicle which we bought. Okay. And whereas our liabilities, income, and capital, these increase on the credit side and decrease on the debit side. Okay, so what we'll be looking at in this module is we will explain the purpose of depreciation. We'll calculate depreciation using the straight line as well as the diminishing balance method. We'll record adjustment and closing transfer pertaining to depreciation. Explain accumulated depreciation. Complete and interpret the asset register, maintain records relating to capital acquisition and disposals, and disclose our property, plant, and equipment in the financial statement year end. So what is depreciation? So if we look at our fixed assets, so for example, a vehicle, you buy it today for 100,000 Rand, and in a year's time, is that vehicle still worth 100,000 Rand? No, it will be worth 90,000 Rand or 80,000 Rand or whatever. So that loss in value is what we call a depreciation. Okay, so the loss in value in our fixed asset is depreciation. So what do we do with depreciation in accounting is we need to adjust for it, and we only adjust for it at the end of the financial year. Okay, when our non-current asset are adjusted as the net realizable value, so the realistic trade value of the asset. So in other words, all our non-current long-term assets, we need to adjust for depreciation. How do we calculate depreciation? Well, we calculate on the original cost price. And if we make an adjustment to the cost price, so if we say our vehicle is 100,000 Rand, it's now depreciated by 10,000 Rand, to be now the value to be now 90,000 Rand. So that 90,000 Rand is then our carrying value or the book value. Okay. So importantly, carrying value is our cost price, and cost price you always need to subtract your residual value. So that is, for example, if you scrap a, or sorry, that is the residual value is if you had to scrap your vehicle or your asset now, what is it that you will get from that asset in terms of essentially scrap value. So we're just going to take our cost price less residual, and then we're going to subtract our depreciation from that, and that equals our carrying value. Okay, so depreciation, most importantly, is classified as an expense. So in other words, the depreciation decreases the value of our non-current asset. Okay, there's a few different methods of depreciation, but the most commonly used methods of depreciation is the straight line method and the diminishing balance method. So with the straight line method, we calculate our depreciation on the original cost price using a predetermined rate of depreciation. So in essence, what we do is we take our vehicle of 100,000 Rand and we're just going to depreciate it at a rate of 10% each year or 20% each year. Okay. So it's our cost price, and then we adjust it at a predetermined rate. So it can either be as a percentage or the useful life of an asset. So if, for example, the useful life of this asset is 5 years, then our depreciation rate will then be 100% divided by 5. So 20% each year. That is what we will need to depreciate this asset at. Then looking at our diminishing balance method, in this method we need to depreciate our asset, but we're going to also add a percentage, but we need to instead of the cost price, we're going to depreciate our carrying value of the asset, and the carrying value is your cost price less accumulated depreciation. Okay, so carrying value is obtained by deducting the accumulated depreciation on the asset from the original cost of that asset. So and then we use the depreciation rate is then applied to this carrying value. So if you look at an example, so just quickly in depreciation, so depreciation, that is classified as an expense, and if expenses increase, then we know that we need to debit this recording. And then what is it that we will have to credit? So we're going to debit our expense account, being depreciation, and we're going to credit accumulated depreciation. And accumulated depreciation is essentially a negative asset. It's referred to as a negative asset, as it's not an income or expense, and that's essentially the loss in value through time or through the previous years of our fixed assets. So it's a sum of all depreciation written off a particular asset until the asset is written off, sold, or scrapped. Okay, and an annual depreciation is an expense in the income statement, while non-current asset is shown in the statement of financial position as the carrying value. So let's have a look at an example. So on the 1st of April 2005, Vortex dealers, a registered VAT vendor, bought a delivery vehicle, so a non-passenger vehicle, for 410,400 including VAT. The financial year of this firm is on the 31st of December each year. Okay. So in accounting, the most important thing is for you to always draw your timeline. So it's said there that the financial year ends on the 31st of December, meaning it started on the 1st of January 2005. And what happened during the year? We bought a vehicle on the 1st of April 2005 for 410,400. Now, this vehicle, this 410,400, it includes VAT, and we know that Vortex Dealers is a registered VAT vendor. So we need to determine whether we can claim back VAT from SARS on this vehicle. With vehicles, you can claim back VAT only on vehicles, only when it's a delivery vehicle or a non-passenger vehicle. If not, then you may not claim back VAT. Okay, so we bought this vehicle on the 1st of April 2005. So we held this vehicle for the period during the current financial year of the 1st of April 2005 up until the 31st of December. So in total we held it for 9 months. We bought this vehicle for 410,400 Rand. Now what we need to do firstly is we now only want to account for we want to break up this price into the cost price and the VAT amount. Okay, because in your vehicles you're only going to record the cost price excluding VAT, and VAT you will then deal with separately in your VAT accounts, in your VAT control. So if we have a look here, our cost price is 410,400. In order to get the price excluding VAT, and assuming in this question it still used a VAT percentage of 14%, we're going to say here 410,400 multiplied by, we want the amount excluding VAT, so we're going to say multiply by 100 divide by 114. So just note that this question still used 14% as VAT. So our cost price excluding VAT is then 360,000 Rand. And on that we need to now depreciate the asset. So what is required from us? So first thing we want to prepare the depreciation and accumulated depreciation accounts for goodwill goodies for the financial year ending 31 December 2005, 6 and 7. And we're going to use a 10% depreciation rate according to the straight line method as well as the diminishing balance method. So if we start off by looking at the straight line method, we want to account for our depreciation. So let's just have a look here. So we know that our cost price we just calculated to be 360,000 Rand excluding VAT. So for the 2005 financial year, what period did we hold this vehicle? We held it from the 1st of April 2005 up until the 31st of December 2005. So we're going to depreciate this asset for 9 out of 12 months, so for the period in which we held it in the current financial year. Okay, so we're going to say 360,000 Rand for the 2005 year, multiply by 9 months, divide 9 out of 12 months, so multiply by 9, divide by 12, and then multiply by 10%. So in the first year, the depreciation for the first year, or for 2005, will be 27,000 Rand. And we're now only using the straight line method, so we're going to depreciate it every year just on the cost price. Okay, so we want to record this 27,000 Rand. What do we know about depreciation? Is we said that depreciation is an expense, and expenses increases on the debit side. So we're going to debit 27,000 Rand in our depreciation account on the 31st of December 2005, and that relates to our accumulated depreciation on vehicles account. And our accumulated depreciation on vehicles account is our asset account, which we which decreases the value of our asset. So meaning it's an asset, so a decrease in an asset will have a credit balance. So we're going to credit 27,000 Rand on the 31st of December, and that relates to depreciation. Okay, so that's looking at the 2005 financial year. So now what we need to do is want to depreciate for the 2006 financial year. And if you go to our timeline, during 2006, we held this vehicle from the 1st of January 2006 up until the 31st of December 2006. So we're going to depreciate this vehicle for the full 12 out of 12 months. So if we have a look at our calculation, we're using the straight line method. So on the straight line method, we just use our original cost price of 360,000 Rand, and that we're going to multiply by, we held this vehicle for 12 out of 12 months, so multiply by 12, divide by 12, and then multiply by 10% our depreciation rate. So in the 2006 financial year, our depreciation was 36,000 Rand. If we record this, then for depreciation, we will then debit depreciation, being our expense, on the 31st of December 2006, and that needs to go to our accumulated depreciation on vehicles account. Now, accumulated depreciation on vehicles account, we will then credit 36,000 Rand on the 31st of December 2006 from our depreciation account. So in total, at the end of December 2006, our total accumulated depreciation will then be 63,000 Rand. Okay, and finally, if we have a look at our 2007 financial year, during our 2007 financial year, we held this vehicle for a full 12 out of 12 months, so we will depreciate this vehicle for 12 out of 12 months. So we're just going to say again, our cost price of 360,000 Rand, multiply by 12, divide by 12, and then multiply by 10%. So the depreciation, according to the straight line method, for the 2007 financial year will be 36,000 Rand. For depreciation, we will then debit 36,000 Rand on the 31st of December 2007, and that needs to go to our accumulated depreciation on vehicles account. And in our accumulated depreciation on vehicles account, we will then credit 36,000 Rand from depreciation. So our total accumulated depreciation as at the end of 2007 will then be 99,000 Rand. So that's looking at the straight line method. It's relatively straightforward. You just need to calculate your depreciation at the cost price, the original cost price, and we also need to proportion it for the period of the financial year in which we held this vehicle. So if we have a look at our diminishing balance method, in the diminishing balance method, what we need to do is at the beginning of each financial year, we need to calculate what our carrying value is for this vehicle. And your carrying value is your cost price less accumulated depreciation. So if we start with the 2005 financial year, in this year we bought this vehicle on the 1st of April 2005, and the value of excluding VAT is 360,000 Rand. During the 2005 financial year, we held this vehicle for 9 out of 12 months. This vehicle hasn't accumulated any prior depreciation, so we'll just use the, in a 2005 year, we just use 360,000 Rand, multiply then by 9 out of 12 months, multiply by 10%, giving us a depreciation rate of 27,000 Rand for 2005. So we will record this depreciation as an expense. We'll debit our depreciation account on the 31st of December 2005, and that needs to go to accumulated depreciation on vehicles account, which we will then credit on the 31st of December 2005, coming from our depreciation. Okay, so the first year is still the same as with the straight line method. Now we need to get to the 2006 financial year. So in the 2006 financial year, we need to start off the financial year by determining what our carrying value is. And carrying value is your original cost price less accumulated depreciation. That equals your carrying value. Okay, so our cost price we know is 360,000 Rand. Our accumulated depreciation, so that's the depreciation from all the prior years. We only had it for the 2005, so we only had 27,000 Rand. So our carrying value is then 360,000 Rand minus 27,000 Rand. Okay, so it's 333,000 Rand. So that's our carrying value beginning 2006. So then what we need to do is on this 353,000 Rand, we will then depreciate for 12 out of 12 months because we had this vehicle for 12 out of 12 months. Okay, so we're going to say here 360,000 Rand minus 27,000 Rand to get to a carrying value of 353,000 Rand. We had it for 12 out of 12 months, and then that value will depreciate at a rate of 10% to get to a depreciation value of 53,300. So we will debit that 53,300 on the 31st of December 2006, and that needs to go to our accumulated depreciation on vehicles account, which we will then credit 53,300 on the 31st of December 2006 coming from depreciation. So total accumulated depreciation as at the end of 2006 will then be 60,300. So beginning 2007 we need to determine what our carrying value is. So our carrying value is then our cost price of 360,000 Rand less than our total accumulated depreciation as per the beginning or the end of 2006. So as per the 1st of December 2007 or the 31st of December 2006. So it's then 60,300. So that means our carrying value on the 1st of December 2007 is in 299,700 Rand, and then that we will then depreciate for 12 out of 12 months. Okay, so we're going to say here 299,700 Rand, multiply by 12, divide by 12, multiply by 10% depreciation. So our depreciation rate is 29,970 for the 2007 financial year. We will debit our depreciation account and we're going to credit our accumulated depreciation on vehicles account. So our total accumulated depreciation as at the end of December 2007 using the diminishing or reducing balance method will be 90,270. Okay, so let's have a look at another question. In this question, we've got Good for Goodies. They bought machinery for 184,680 Rand on the 31st of October 2002. It was decided to depreciate all non-current assets at a rate of 33.33% according to the diminishing balance method. So diminishing balance method means we will have to determine our carrying value each year. So required is prepare a depreciation in the general ledger as well as prepare it in the general journal, whereas our financial year ends on the 30th of April 2003 and 2004. Okay, so if you have a look here at our timeline, so our financial year ends on the 30th of April 2003, meaning it started on the 1st of May 2002. We bought this vehicle on the 31st of October 2002. In other words, we're just going to make it the 1st of November 2002. So during the 2003 financial year, we held this vehicle for from the period 1st of November 2002 or 31st of October up until the 30th of April, so for 6 out of 12 months. Okay, so if we look at our cost price was 184,680. So this we will have to depreciate at a rate of 33.33% for 6 out of 12 months. Okay, so we're going to say 184,680 multiplied by 6 out of 12 months in which we held this vehicle in the current financial year, and then multiply by 33.13% gives us a depreciation rate of 30,780. We know that depreciation is an expense, so we will debit our depreciation account on the 30th of April 2003, and we will credit our accumulated depreciation on machinery account, which is the loss in value of our asset, and our asset is decreasing. Okay, and what we also do is our depreciation being an expense, to close off that account, so we'll just take this 50,000, take it to the credit side, and then we'll take it to our profit and loss account. So that's looking at it in our general ledger accounts. Let's have a look at how we do it in our general journal. So in our general journal, we'll start with our heading. We've got a general journal of goodwill goodies for April 2003. We know that we debited our depreciation because that is our expense, and our expense increased. So we're going to debit depreciation 30,780, and we're going to credit our accumulated depreciation on machinery, which is the loss in value of our asset. So our asset is decreasing in value, so that's why we credit that amount. And then to close off our closing transfer for depreciation, we went and just credited depreciation and debit our profit and loss account. Okay, so if we have a look here, now we start off with the beginning of the 2004 financial year, which starts on the 1st of May 2003. So we want to determine what our carrying value is as per the 1st of May 2003. So carrying value is our cost price of 184,680 minus our total accumulated depreciation from all the previous years. So we only have accumulated depreciation from the previous year, and that was 30,780. So our carrying value as at the beginning of 2003 is then cost price less accumulated depreciation. So will then be 153,900. So it's 153,900 rand. We will then depreciate for 12 out of 12 months at a rate of 33.3%. Okay, to get to a depreciation amount of 51,300 rand. We will debit our depreciation expense account, and we're going to credit our accumulated depreciation account on machinery. And in total, our depreciation for the year was then 82,080 rand. Sorry, our total accumulated depreciation as per the end of 2004. Recorded it in our general journal, so we will debit our depreciation account and credit our accumulated depreciation account. So that's just dealing with our straight line method and our diminishing balance method, and how we account for it in our general ledger and our general journal. The next thing what we want to look at is what happens when we dispose of one of these assets. So when we sell one of these fixed assets. In other words, we've got a vehicle which we originally bought for 100,000 rand, and now we sell it 2 years later, 3 years later. So what we want to do is we want to determine whether we made a profit or a loss in this disposal of this asset. So we've got our vehicle which has a cost price of 100,000 rand, and it depreciates at a rate of 20% each year. So on the straight line method, let's just take that, make it easy for now. So after 2 years, the total depreciation will then be 40,000 Rand. And our carrying value will then be 60,000. So it's 100,000 Rand less the accumulated depreciation of 40,000 Rand, giving you 60,000 Rand. If you, for example, sell this vehicle at the end of 2 years and you sell it for, let's say, 65,000 Rand, then that means you essentially made a profit of 5,000 Rand because you sold it for more than what you have this vehicle, the book value of this vehicle in your books. Okay, so that's where the whole asset disposal procedure comes in. Now, asset disposal, we need 3 things. We need the selling price, we need the initial cost price, and we need the total accumulated depreciation as per the date of sale. If we have these 3 things, then it's relatively simple. So how we deal with this asset disposal procedure is we do it in 4 steps. Step 1 is what we need to do is we need to take the initial cost price out of the books. So in other words, we're going to debit our asset disposal account and credit our asset account. So if you look at how we're going to do it, so firstly what we want to do is want to create an asset disposal account because we're disposing of one of our fixed assets. Then with step 1, we need to take the asset account out of our books. So what we're going to do is we're going to have a balance brought down. So that will be our 100,000 Rand. But now we're disposing of this vehicle or this asset. So we do not have this vehicle, this asset anymore. So we need to take it out of our asset account. And we do that by taking it to the credit side because that decreases your asset. So if we credit our asset account, then that means we will debit our asset disposal account. Okay. Our second step is to take the accumulated depreciation out of the books. So we're going to credit our asset disposal and debit accumulated depreciation account. So if we do that, our accumulated depreciation is in a negative asset, so that normally decreases the value of your asset. So it will have a credit balance, but now we want to take that value out because we do not own this vehicle or this asset anymore. And to take it out, we will need to take it to the debit side. So we're going to debit our accumulated depreciation account and we're going to credit our asset disposal account by what the value is. Okay. Step 3 will then be to record the selling price. Now if we sell it, it can either be a cash sale, so in other words it will be bank, it can be a credit sale, so we debtors control, or a trade-in, so that will be our creditors control. So we're going to debit our bank, debtors control or creditors control, and we're going to credit our asset disposal account. And finally, step 4 is we want to calculate whether we had a profit or a loss in disposal of this asset. So we're essentially just going to balance out our asset disposal account. And if we balance it out and we see that the balance is on the debit side, then that will mean we made a profit on disposal of this asset. If we balance it out and we see that our balance is on the credit side, then that means we made a loss in sale of this asset. And then we'll just record it in our accumulated profit or loss on disposal of asset account, with the profit or a loss. Okay, so these are the 4 steps. So most importantly is you need to have your selling price, you need to have the original cost price and accumulated depreciation, and you just follow these 4 steps. So if we have a look at an example. Okay, so in this example we've got Walton Stocklitz who bought all the office furniture on the 1st of January 2006 for 25,000 Rand. Okay. Then 1 year later, on the 1st of January 2007, the business sold all the furniture for 18,750 cash. So it was a cash sale. The total depreciation written off in the first year amounted to 7,500 Rand. And the financial year of this business ends on the 31st of December each year. So if we draw our timeline, we bought this vehicle, this furniture, on the 1st of January 2005 for 25,000 Rand. That was the cost price of this furniture. We held it for the full 12 out of 12 months, and it depreciated for this period at a rate, it depreciated at a value of 7,500 Rand. And then we get to the 1st of January 2007, 1 year later, and we sold this furniture at the beginning of the next financial year, and the selling price was 18,750. So what is required from us is to account for the asset disposal procedure. And what is the three things that we need in this? We need our original cost price that we have as 25,000 Rand. We need the depreciation. We need the total accumulated depreciation as per the date of sale, and they gave it to you as 7,500 Rand, and you need the selling price. Okay, and we know that we sold this for cash, so in other words, our bank account. We received money in our bank account. So if we look at it, it's very simple. All you need to do is just slot in these accounts. So on the 1st of January 2007, our balance brought down in terms of furniture was 25,000 Rand. So we will debit that. Step 1 in our asset disposal procedure is we need to take out this furniture because we do not own this furniture anymore. In order to take out this furniture, we need to decrease our assets. And decreasing your assets, you need to credit that value. So we're going to credit 25,000 Rand on the 1st of January 2007, and that needs to go to asset disposal. In our asset disposal account, we will then debit 25,000 Rand on the 1st of January 2007, and that relates to furniture. Okay, so if we have a look at our step 2, being to take out the accumulated depreciation, what we have is on the 1st of January 2007, our balance brought down in terms of accumulated depreciation on furniture was 7,500 Rand. We want to take it out, so we need to then take it to the other side. So we will have to debit that 7,500 Rand on the 1st of January 2007, and that needs to go to asset disposal. Now, asset disposal account, we will then credit 7,500 Rand on the 1st of January, and that relates to our accumulated depreciation on furniture. Step 3 is we want to record the selling price. So it said that we sold this asset for 18,750 cash. So we received money in our bank account. Bank is an asset to you, and we know that assets increase on the debit side. So we will debit 18,750 on the 1st of January 2007, and that needs to go to the asset disposal account. And in our asset disposal account, we will credit 18,750 towards bank. Okay. So step 4, our final step, is to determine whether we made a profit or a loss in the sale of this asset. And if we account for it, we need to balance out our asset disposal account. So if we look on our credit side, we've got 7,500 and 18,750. So in total, 26,250. If we look at our debit side, we only have 25,000 Rand. So our balance will then have to be on the debit side. So in order to get this 25,000 Rand to 26,250, we have to increase it by, or we will have to balance it out by 1,250 on the debit side. And if it's on a debit side in our asset disposal procedure, then that means we made a profit on disposal of this asset. So in our accumulated profit on disposal of assets, we will credit 1,250 Rand. Okay, so that's in a nutshell just your asset disposal procedure. You need to know what we do in our general journal. So that's relatively simple. We credited our furniture and debited our asset disposal. We debited our accumulated depreciation on furniture, credited our asset disposal, and then we debited our asset disposal procedure after we balanced it out and credited our profit and loss. And also we just recorded our cash sale in our cash receipts journal. Okay, so that's looking at a simple example of your asset disposal procedure. But in practice, what you will have is you will not always get it will not always be as simple. You will, for example, do an asset disposal procedure from a pool of assets. So in other words, you've got many vehicles and now you're only selling one of those vehicles. Okay, so what we need to do is we still need to account for the sale of that one vehicle, and then at the end of the financial year we need to record the accumulated depreciation. We need to record the depreciation for our remaining vehicles. Okay, so let's have a look at this question. So from this, we've got the following balances appears in the books of beauty products on the 31st of March 2003. So we've got a balance for vehicles of 276,000 Rand and for accumulated depreciation of 74,400 Rand. So that's the end of our previous financial year. Then we get to the 1st of April 2003. So that's the beginning of our current financial year. We went and a vehicle which had original cost price of 84,000 Rand, and up until the 1st of April 2003, its total accumulated depreciation of 52,380. We took this vehicle and we traded it in for a new vehicle from Kendra Motors. The purchase price of this new vehicle was 135,000 Rand, but from our older vehicle, we got a trade-in value of 30,000 Rand. So that's essentially the selling price of our older vehicle. And this balance was financed through a hire purchase loan from Zeta Finance. So beauty products depreciate at a rate of 25% according to the diminishing balance method. And what we need to do is we need to prepare the ledger accounts relating to asset disposal for the year ending 31 March, and also I want to do it in the subsidiary journals. So let's look at what information we have. So our financial year is from the 1st of April 2003 and it goes up until the 31st of March 2004. So our balance from the previous year towards vehicles was 276,000 Rand, and towards accumulated depreciation it was 74,400. Then this 274,000 Rand includes a balance of 84,000 Rand. So that's a vehicle which we bought in the past, but now we dispose of this vehicle. So we sold this vehicle. The original cost price was 84,000 Rand, whereas the accumulated depreciation as per the date of sale was 52,380. And we sold this vehicle but traded it in. We got a trading value of 30,000 Rand to buy a new vehicle of 135,000 Rand. So what we need to do is we first need to record everything relating to the disposal of this vehicle, and then at the year end on the 31st of March 2004 we need to record the depreciation for the year. So let's have a look. So let's start with our balances. So our vehicles, on the 1st of April 2003, our balance towards vehicles was 276,000 Rand, which we will then debit. Towards accumulated depreciation, there we had a balance of 74,400 Rand on the 1st of April 2003. A balance brought down. So let's start with our asset disposal procedure. So step 1 is we want to take out the original cost price from our asset account. So it has a balance, our vehicles has a balance of 276,000 Rand, but we dispose of one of our vehicles, and the cost price of that was 84,000 Rand. So in order to take that 84,000 Rand out of our vehicles account, we will need to credit that amount. So on the 1st of April 2003, we're going to credit 84,000 Rand, and that relates to our asset disposal. Our asset disposal account we're going to create, and on the 1st of April 2003 we will debit 84,000 Rand, and that's coming from our vehicles account. Okay, what else happened on the 1st of April? We need to now, step 2, take out the accumulated depreciation as per the date of sale. So on the 1st of April 2003, our balance was 74,000 Rand. Now we sold this vehicle, which had an original cost price of 84,000 Rand, and up until the 1st of April 2003, date of sale, we went and the total accumulated depreciation was 52,380. So we need to take that out. How we do it? So we just need to take it to the debit side. We're going to debit 52,380 on the 1st of April 2003, and then we need to take that to our asset disposal account. And in our asset disposal account we will credit 52,380. Okay. We went and we also bought a new vehicle. The cost price of that new vehicle was 135,000 Rand. So in other words, our vehicles being our asset account, we need to increase by 135,000 Rand. So we're going to debit 135,000 Rand on the 1st of April 2003, and that relates to a loan which we took out from Zeta Finance. Okay, so we will credit our hire purchase loan Zeta Finance. Okay. But we also need to record how we dispose of this vehicle. We disposed of this vehicle by trading it in, and we got 30,000 Rand from this trade-in. So we will then credit 30,000 Rand on the 1st of April 2003, and that relates to our hire purchase loan on Zeta Finance account. Okay, that's step 3. And then step 4 is to finally just balance out our asset disposal account. And if we balance it out, we find that we are short on the credit side, so we will balance out our credit side by 1,620 on the 1st of April 2003. And if your balance is on a credit side in your asset disposal procedure, then that means you made a loss on disposal of this asset. So we will then debit our accumulated loss on disposal of asset account coming from the asset disposal account. Okay. So that's everything relating to the 1st of April 2003. Now, as I mentioned, we're now at the 31st of March 2004, and for that we need to determine our depreciation for the year on these older vehicles, excluding the vehicle we sold. This vehicle we sold, we do not own it anymore, so we're not going to account for depreciation. And then on this new vehicle, we need to account then for depreciation. So if we have a look at it, on our new vehicle, we know that the cost price was 135,000 Rand. There's no carrying value because we bought it during the current financial year. So if we depreciate that, then we're just going to say 135,000 Rand multiplied by 12 out of 12 months in which we owned this vehicle, and multiplied by a rate of 25%. So this new vehicle depreciated its depreciation for the year was 33,750. Okay. If you look at our older vehicles, we know that our cost price on our older vehicles, our balance was 276,000 Rand, but that includes the 84,000 Rand of the vehicle which we sold. So we need to take that 84,000 Rand out of that balance to get to a cost price of 192,000 Rand, because we do not own that 84,000 Rand vehicle anymore. And we need to do the same for our accumulated depreciation. So our balance was 74,400 Rand, less than the vehicle sold accumulated depreciation of 52,380, gives us then a total accumulated depreciation on our older vehicles of 22,020 Rand. So now we need to calculate our carrying value, and our carrying value is of cost price of 192,000 Rand, less accumulated depreciation of 22,020 Rand, giving you a carrying value of 169,980. That we will then depreciate for 12 out of 12 months at a rate of 25% to get to a depreciation amount of 42,495. So our total depreciation as at the end of the year is then 76,245. We're going to record it as an expense, so we will debit our expense account and we're going to credit our accumulated depreciation account on vehicles with 76,245. And then finally we just need to balance out our vehicles and accumulated depreciation account. So if we balance out our accumulated depreciation account, then it will balance out on the debit side. So the 1st of April 2004, our balance brought down from the previous year will then be 98,265 Rand. Same with vehicles. If we balance it out, our balance will be on the credit side. And then on the 1st of April 2004, our balance brought down from the previous year will then be 327,000 Rand. Okay, so just quickly on how to do it in our general journal. So we will debit our vehicles account, credit our hire purchase loan. So this is buying the new vehicle. Disposing of that vehicle, the older vehicle, we will credit our vehicles account, debit our asset disposal account to take out the cost price of that vehicle. We will want to take out the accumulated depreciation on this vehicle as well. So we'll debit accumulated depreciation on vehicles, credit asset disposal, and then our hire purchase loan. We will then, this is our selling price, we're recording that. So we will debit our liability, which is now decreasing by 50,000 Rand because that's the trade-in value. And we're going to credit our asset disposal account by 50,000 Rand. And finally, our loss on disposal of asset, we will then debit. We balance out our asset disposal account and determine that we made a loss on disposal of asset, which we will debit, and we'll credit our asset disposal account. Okay, so that's looking at it. And then finally, so all of this happened on the 1st of April 2003, but now we get to the 31st of March 2003. And then for that, we just need to record our depreciation expense, which increased. So we will debit our expenses of 76,245, and we're going to credit our accumulated depreciation on vehicles, 76,245 Rand. Okay, so that's looking at our asset disposal procedure when we dispose of this asset on the beginning of our financial year. And also we now had a look at if we had a pool of assets, so more than one vehicle. How do we account for that? But as you know, in practice, you don't always buy or sell your vehicles or your assets on the first day of the financial year. You buy or sell it midway through the year. And that's why we need to now account for that. So in order to account for our disposal midway through the financial year, most of the things will still be the same, being that we still only need the cost price, we need the selling price, and we need the total accumulated depreciation as per the date of sale. And that's essentially where the change comes in, is the total accumulated depreciation as per the date of sale. So we've got our accumulated depreciation as at the beginning of the year, so that we will have, but then we also need to calculate our depreciation for the current financial year until the date when we sold it. So if we look at our 4 steps, so step 1 is we need to take out the initial cost price out of the books, so that's still the same. But step 2 is divided into 2 parts. So firstly, we need to write off additional depreciation of the assets being sold. So that's looking at the depreciation for the current financial year. And then secondly is to take the accumulated depreciation out of the books. So it's just a step 2A which comes in. Is we just need to write off additional depreciation covering the period from the beginning of the financial year to the date of when the sale takes place. And in step 3 is to record the selling price, and step 4 is to calculate the profit or loss with disposal. Okay, so if we have a look at this question, it says there, the following balances, amongst other, appeared in the books of Sylvina Traders on the 1st of September 2007. So we've got a balance for vehicles, 700,000 Rand, and for accumulated depreciation on vehicles, 140,000 Rand. So what is required from us? We want to show the following accounts in the books of Sylvina Traders for the financial year ending 31 August 2008. So for vehicles, accumulated depreciation, and asset disposal. So let's have a look at our timeline. So our timeline is from the 1st of September 2007, and our financial year ends on the 31st of August each year, and the current financial year is the 31st of August 2008. So our balance in terms of vehicles was 700,000 Rand, and our balance in terms of accumulated depreciation was 140,000 Rand. Okay, so let's record that. So we've got our vehicles account. We're going to debit 700,000 Rand on the 1st of September 2007, which is our balance brought down in terms of vehicles. And for accumulated depreciation, we're going to credit 140,000 Rand on the 1st of September 2007, and that's our balance brought down in terms of accumulated depreciation. So all of this happened on the 1st of September. Then during the year, the following transactions took place. So firstly, on the 28th of Feb 2008, a new vehicle was bought, 231,000 Rand cash. We go to our timeline, and in our timeline, we bought a new vehicle on the 28th of Feb 2008, and the cost price of that was 231,000 Rand. So let's record that in our vehicles account. So in our vehicles account, on the 28th of Feb, we're going to debit our vehicles account 231,000 Rand, and that's because our vehicles increased in value, and we bought a new vehicle cash, so that we paid from our bank account. Okay, so that's recording our new vehicle which we bought. Then on the 1st of June 2008, an old vehicle which has been bought on the 1st of December 2005 for 280,000 Rand was sold on credit for 157,500. Okay, so here we're now on the 1st of June 2008, and our original cost price of this vehicle was 280,000 Rand, and this vehicle we sold on this day. We bought this vehicle originally on the 1st of December 2005. Okay, so on the 1st of December 2005, that is when we bought this vehicle. Okay, so what we need to do is, in order to complete our, so we're going to now record this asset disposal. So let's start with step 1. So step 1 we said is we need to take out the cost price of this vehicle, the original cost price of the asset. In order to take it out, we need to decrease our assets. And if we decrease assets, then we know we're going to credit that. So we're going to credit 280,000 Rand on the 1st of June 2008, and that needs to go to our asset disposal account. And in our asset disposal account, we will then credit 280,000 Rand on the 1st of June 2008, and that relates to vehicles. Step 2 is broken now up into 2 parts. Here we have, firstly, we need to record the depreciation for the year, and then we need to take out the total accumulated depreciation. So if we look at our vehicles, we want to now record. So we know that at the beginning of the year, this vehicle, it had a cost price of 280,000 Rand. But we do not know what our accumulated depreciation is as per the beginning of the year. So we cannot determine our carrying value, because our carrying value, you know, is your cost price less accumulated depreciation equals your carrying value. So we've got our cost price, but we do not have our accumulated depreciation. What we do have is we know when we bought this vehicle originally. So originally bought this vehicle on the 1st of December 2008, and we bought it at a cost price of 280,000 Rand. So what we need to do in order to get the accumulated depreciation as per the beginning of our current financial year, so in other words the beginning of 2007, we need to now calculate the depreciation up until that date. So we need to look at the depreciation from the 1st of December 2005 okay, and that will then be a cost price of 280,000 Rand multiplied by 9 out of 12 months. That's the period we held this vehicle, and multiplied by a rate of 25%. Of 20%. So if you look at the vehicles, so for the period, the 1st of December 2005 up until the 31st of August, the end of our 2006 financial year, our cost price is 280,000 Rand at a rate of 20% for 9 out of 12 months. So our depreciation will then be 42,000 Rand during the 2006 financial year. If we get to our 2007 financial year, in our 2007 financial year, on the 1st of September 2006, our cost price of this vehicle is 280,000 Rand. But our accumulated depreciation up until the date of sale is then 42,000 Rand. So that's the depreciation so that's the depreciation from the previous year. So carrying value at the beginning of the financial year is then going to be 238,000 Rand. And on that we then need to depreciate for the full 12 out of 12 months, because we held this vehicle for 12 out of 12 months. So if we calculate that, then our current value is then our cost price of 280,000 Rand less our accumulated depreciation of 42,000 Rand. So then our carrying value is 238,000 Rand. That we're then going to depreciate at a rate of 20% for 12 out of 12 months, giving you a carrying value of, or a depreciation for the 2007 year of 47,600 Rand. Okay. So then we get to the beginning of our current financial year. In our current financial year, we know that this vehicle, it has a cost price of 280,000 Rand, and it will then have accumulated depreciation of 42,000 Rand from the previous financial year, from the 2005 financial year, and plus 47,600 from the 2007 financial year. So the total accumulated depreciation as per the beginning of the year is 89,600. And then to get our carrying value, we will then take our cost price, 280,000 Rand, minus then this 89,600 Rand. So our carrying value for this vehicle at the beginning of the year is 190,400 Rand. And that we then need to depreciate up until the date of sale. So up until the 1st of June 2008. So if we calculate that, we're going to take our carrying value of 190,400 Rand, depreciate at 20% for 9 out of 12 months. So the current depreciation for the current financial year is 28,560 on this vehicle we're selling. So to record that depreciation on the 1st of June 2008, we're going to credit our accumulated depreciation on vehicles account 28,560. Okay. Now we know that we also disposing of this asset, so we need to now add all the depreciation of this asset as per the date of sale. So that's going to be the 42,000 Rand from 2006 financial year, the 47,600 from the 2007 financial year, and the 28,560. That's for the depreciation during the current financial year. We need to take that out, so we're going to credit our accumulated depreciation account on the 1st of June 2008. We need to take that to our asset disposal account, which we're going to debit our accumulated depreciation account, and we're going to credit our asset disposal account. Okay, and then we need to record how we dispose of this asset. If we go back to the question, it says there we sold this asset on credit for 157,500 Rand. So then we're going to credit 157,500 Rand, and that's on the 1st of June 2008, and it's because it was a credit sale. So we will, that's coming from our debtors control. And if we balance it out, then our asset disposal account will then have a credit balance of 4,340. So we made a loss on disposal of this asset. Okay, so now we're on the 1st of June 2008, but now we need to get to the end of our financial year, so the 31st of August of 2008. And to get to that, we now need to look at the depreciation for this new vehicle which we bought. This new vehicle we held from the, from the 28th of February 2008 up until the 31st of August. And also on this older vehicles, we need to depreciate those vehicles. So if you look at it, our new vehicle, it has a cost price of 231,000 Rand. We're going to depreciate that for at 20%. For 6 out of 12 months. So our depreciation on this new vehicle is in 23,100 Rand. And then on our older vehicle, we're going to determine our carrying value. So our carrying value, if we go back to our balances, beginning of the year, our balance towards vehicles was 700,000 Rand. But that 700,000 Rand includes this vehicle that we sold of 280,000 Rand. So we need to take out that amount first. So if you take it out, our cost price will then be 700,000 Rand less 280,000 Rand. And the same for accumulated depreciation. I'm going to say 140,000 Rand less 89,600 Rand. And that we will depreciate at a rate of 20% for 12 months. So our total depreciation for our older vehicles is then our total depreciation as per the 31st of August 2008 will then be the 23,100 on the new vehicles and the 73,920 on the older vehicles. So in total, 97,020 Rand. So that we need to then record on the 31st of August 2008, depreciation 97,020 Rand. Okay, and then the final thing that we need to do is we just need to balance out our accounts. So if we balance out our accumulated depreciation account, then it will balance on the credit side. So on the beginning of September 2008, the beginning of our next financial year, our balance towards accumulated depreciation is 147,420. The same for vehicles. If we balance it out, beginning of the September 2008, the beginning of our next financial year, our balance in terms of vehicles is then 651,000 Rand. So in this question, what we had a look at is we took into all the steps in our asset disposal procedure. So we looked at if we have a pool of assets, so more than one vehicle, how do we account for that? And we also had a look at how do we account for depreciation or for asset disposal when we dispose of the asset midway through the financial year. So the most important thing to do is you always need to draw your timeline. Your timeline is your best guide as to how to look at, as to how to answer the question and how to understand what is going on. So it basically draws a picture of what is going on. Okay. So the final thing that we need to have a look at in this module is just our disclosure of depreciable assets. And for that, when we do our financial statements, we have certain notes that gives more information on what these notes just gives more information on the items in our statement of financial position. And one of those notes is our property, plant and equipment note. And that's a summary of all our fixed assets which does depreciate. So it's land and buildings, so that doesn't depreciate, that actually accumulates in value. But all other assets, so our vehicles, equipment, furniture, machinery, all of these we need to look at what is our carrying value, our movements during the year, and our carrying value as at the end of the year. So the note looks at as follows. So it's just going to be our carrying value as at the end of the previous financial year. Carrying value is your cost price less accumulated depreciation. It's your movements during the year. So then those movements are if you bought any additional asset, and that should always be as per the cost price. It should be your disposables, and that's always as at carrying value and depreciation for the year. And then finally we've got our carrying value as at the end of the year. So that's our cost price less accumulated depreciation. So if you work through the learning module in terms of which relates to your financial statements, then we will go through these disclosures of depreciable assets in detail. But for now, just know and understand the note and how it looks. So in this learning module, what we had a look at is we had a look at what is the different types of depreciation that you can have. So it can either be straight line or diminishing balance method. We had a look at how we account for that and how we record that in our general ledger as well as our general journal. We also had a look at our asset disposal procedure, and in our asset disposal procedure we looked at if we dispose of an asset at the beginning of the year, we dispose of an asset from a pool of different assets, so more than one vehicle, And also we looked at our asset disposal procedure as when we dispose of the asset midway through the year. And then finally, we just touched on our disclosure for depreciable assets. So that's in a nutshell basically everything related to depreciable assets.